Hello and welcome back. Today we'll continue our series on financial analysis by using the company NASCON Allied Industries Plc. We've checked the income statement, the balance sheet, and the statement of cash flow. And we also dealt with one of the ratios last week on that performance ratio, which is the profitability ratio. We look at the calculation as well as the interpretation or the analysis of this ratio, what they actually mean, basically. So we'll continue by looking at efficiency/activity ratio, still under performance ratio. We're going to be looking at the composition of what is called the working capital, which makes up the efficiency ratio. So we have the working capital to be your current assets minus your current liability. This is the CFI Institute's material. So we have your working capital to be your current assets minus current liability. So there are a lot of items under the current assets. There are lots of items under the current liabilities. But the three key things we're going to be looking at is basically your inventory, your receivables, and your payables, which are what makes up the working capital itself. So we have the meaning of inventory. Your inventory is basically your raw materials or your goods that are kept in store for the production of goods and services, or for the production of goods, basically, to have to resell to gain revenue. That's for your inventory. Your receivables, also called your debtors, goes in line with your customers. When your customers are owing you, they bought goods on credit from the business. So we have what is called receivables. While for payables, this is in terms of suppliers, which is also called creditors. So the business is owing supplier. It buys raw materials from the suppliers and credits. So these are what makes up the payables. So again, the composition, you have your inventory, your receivables, and your payables. So we are going to be going straight on to the calculation aspect, like we did last week, the calculation first, then the interpretation later. So we have the inventory turnover ratio, the inventory days alongside all the receivables and payables. So we are going to move straight up to the formula. So for the formula, we have two, which is the inventory turnover ratio and the inventory days ratio. For the turnover ratio, like we checked last video, your turnover ratio basically measures how many times this particular item covers this other particular item. So I'm going to be explaining more when we get to the interpretation. What we have for your inventory days is basically expressing it as a percentage of days. We can also have weeks. In this case, the 365 days is going to change to either 52 weeks or 53 weeks, as the case may be. So that's the first one for inventory efficiency ratio. So we just go straight up to the calculation aspect. So we start with inventory turnover ratio. Our inventory turnover ratio is basically our cost of sales divided by our inventory, as we have seen from this. So we start our formula with equals to in Excel. Go back to our financial statements. Under the income statement, we're going to be having our cost of sales divided by our inventory. So we can find our inventory in the balance sheet, which is basically our closing inventory. So I have inventory still for the same year, 2021. Select this. So I'm going to change this because our cost of sales, we need it in absolute figures. It's in bracket already, which means it is a minus. So I need to change to absolute figures. I can do this by two ways. Is either I come down to my formula bar here, prior to the cell that was selected. I can either have ABS, which means make it an absolute figure, or I can just put a minus sign in front, meaning minus times minus give you plus, making it absolute figure, depending on what you want. So I'm just going to stick with minus sign, then I have answer. So we have this as the ratio. So, okay, then let us copy to the right now. When we are done with every single thing, then you can just copy down to the right immediately. So I'm going to be moving on to the next one, which is our inventory days ratio. Sorry, inventory days ratio, yes. So what we need basically is our inventory, which we can get from our balance sheet, our cost of sales alongside 365 days. So I'm going to be showing out a shortcut or a function in Excel that is going to actually spill out this ratio for us, the 365 rather. Yeah, so we're going to be using an Excel function called dates. So I'm just going to combine it where I have my years, or let's do it here. Where I have my years, let me just create an additional, yeah. So I'm going to come here. I have my date equals to date function. Just call out the date function. So I have three parameters there: the year, the month, and the day. So this year is basically 2021, comma. How many months do we have in a year? We have 12 months. And how many days? Just for the generic 31 days. Close this, minus, call your date function again. What year do we have? I'm just going to go to the prior year earlier. So I'm just going to put 2020 right here in this particular cell, or I can just add code. But remember, one of the easiest thing you can do in Excel to make your work easy is basically cell referencing instead of add coding. So I have 12 year, 12 months rather, 34. Then I have enter. So I'm just going to come down to cell E4, put in 2024 year. So we have 365 days. So just copy down to the right. So we have 365 and some year we have 366. That's the purpose of this dates function, because you can actually start calculating if you're going to be having 365 or 366. It's a leap year or just an ordinary year. So that's the purpose of this function. So we'll go back to what we are doing, or we're doing rather, inventory days. So our inventory days equals to, we have our inventory initially as the numerator divided by our cost of sales. Where I remember I said we need to make this absolute figure. So I'm just going to put in a minus sign before selecting this actually. Come down to the formula bar, try to put this in a bracket. Put that in a bracket also. Then shift 8, multiply by 365. Then we have our enter. So we have 73 days approximately. We're going to come down to the interpretation. Stay with me. So move on to the next one, which is basically our receivables. Go back to our material here. Our accounts receivables, like I explained, your debtors relating to your customers. So we have the one for the turnover ratio, which is your sales divided by your accounts receivables, and your receivable days ratio, which is the accounts receivables divided by your sales times 365 or 366 days if it is a leap year. So go back to our Excel sheet, come down to receivable turnover ratio. So we have equals to your sales, which is the same thing as the revenue for this particular year, 2021, divided by your accounts receivable. Go down to our balance sheet to actually check what our accounts receivable is, which is trade and other receivables. Take this, I forgot to put this in a bracket because of Excel function. Then shift 8 multiplied by the number of days that we have, 365. Then we have enter. Then we do the same thing for receivable days ratio also, which is our formula, just the inverse, which is basically your accounts receivables, divided by your sales. Then quickly put that in a bracket, multiply by 365 days. Then we have enter. So we'll go down to the last one, which we are going to be having here. Accounts payable efficiency ratio. So we have for accounts payable also, we have cost of sales divided by accounts payable, cost of sales divided by accounts payable divided by cost of sales also. So we start with the first one, payable turnover ratio equals to the cost of sales. Let me actually put that in the bracket. The cost of sales, make it an absolute figure. The cost of sales divided by accounts payable. I'm doing with accounts payable. So we go down to our current liability sections. Accounts payable, shift 8, multiply by 365, enter. Okay, we're having a little bit of error here. I'm just going to take this out. Yes, and we are good to go. So we have our payable days also. Our payable days is basically your accounts payable under the liability section divided by your cost of sales. Make that an absolute figure. I'm going to have this here. alongside this, multiply by 365 days, and we are good to go. Yeah, so I just noticed some error in what we did. So for your turnover ratio alongside your turnover ratio, you don't the formula does not include the 365 days. I just remember I did that. So I'm just going to pick it out. And this also take the 365 days out. Sorry for the mistake. Take that out. Yes, so we are good to go. So I'm just going to come here, Control Shift down key, then select this, Control R to copy down to the right. And yeah, reduce the number of decimal that we're going to be having. Yeah, so we have days and we have the one for ratios. So I'm going to teach us also insert times, which means the number of how many times a particular item is getting itself utilized. So we are going to be having maybe 5x of some sort. So we mean our inventory turnover at this case is going to be our inventory is actually turned over 5 times basically. So how to do that? Select this. I'm just going to select everything at once. Those one that involves the ratio. Select that. Select this. Then Control 1. So we go down to our custom formatting. Down to our custom formatting. What I just need to put down, come down to the type, just put in your X. Then I have OK. So we have this alongside this. So the one for these, we can do the same thing by infusing this. So select this, hold down your control, select this also, and select the last one. Then Control 1 also, go down to your custom formatting, and I'm going to go to this as this, then enter. So we have this for this. Basically, it kind of looks a little bit rough. So you can just decide to Control Z, so it does not look rough. So we can have something like under this particular column, I'm gonna have X here, then I can have this here. So I can just try to enlarge this particular cell. This, yeah, Control C, just face down, depending on what you want actually. Control C and paste down. So I'm just going to select everything, slant it a little bit. Then I'm going to actually reduce the color of the text. Yeah, it should not be actually too bright. So and we are good to go for that. So next one, we are going to be looking at our working capital funding gap. Then we move on to the interpretation of this ratio itself, a comprehensive interpretation. Yeah, so for our working capital funding gap, so we are going to be looking at the composition of what I said makes up the working capital, which is your inventory, your receivables, and your payables. So the formula basically is your inventory days plus your receivable days minus your payable days. That's what makes up our working capital funding gap. So I'm going to be analyzing, be interpreting this against the interpretation. So we have your inventory days plus your receivable days minus your payable days. Select this, and we have enter. So we have that, and we have this. So the interpretation of this, basically, we are going to be starting from the days. Actually, I want us to pay attention to the days. Let's come here to our working capital. Yeah, so we can actually see this. So this is our working capital. So for our accounts receivables plus inventory minus accounts payables, our accounts receivable days, inventory days, and accounts payable days. So we are looking at how many days it actually takes for our customers to pay us back the goods that was bought on credit. That is for accounts receivables. I'm starting with this initially, accounts receivables here. So how many days it takes for our customers who bought goods on credit to actually pay us back? That is the interpretation for accounts receivable days. If we go back to our Excel sheet for accounts receivable days, which is this, so it takes them 107 days to actually pay us back in 2021. If I'm correct, this is the 2021 figure, basically. So this is kind of huge amount. So I'm going to be telling us why it's the bad thing actually when we get there. For inventory days, it actually tells us how many days it takes for us to take those inventory, which is our raw materials, and transform them into finished goods that can be sold to customers. That's for inventory days. Or for accounts payable, it tells us the amount of days it actually takes the business to pay back its supplier for goods bought on credits. So accounts receivable deals with customers. How many days take the customers to pay us back the amounts owned, to pay the business the amounts owned. For inventory, how many days it takes to convert the raw materials into finished goods. Then accounts payable, how many days it takes the business to pay its customers the goods bought on credit, raw materials bought on credit. So for your accounts receivable, it is the bad thing when it is the increasing, and for your inventory, it's the bad thing when it is actually increasing. Because you need money to meet up your day-to-day activities, which is the purpose of your working capital. You need money to actually fund your day-to-day activities. So it's the bad thing when this is increasing. It's the bad thing when your inventory is actually increasing. Also, it means you are not actually selling more goods because it takes time for you to actually convert your raw materials into finished goods. It takes time for you. So you are not selling more goods. The volume of what you're selling is low rather. Then you have your accounts payable. So your accounts payable, it is actually a good thing for when it is higher, basically. It's the good thing, meaning even when we receive money from our accounts receivable from our customers to pay back our accounts payables, maybe it takes us 30 days to receive money from our customers, but the agreements we have with our supplier is 60 days, which is actually high, 60 days to pay them back. So within that 60 days and 30 days gap, the business can actually invest that money to actually get return within that 30 days and pay back its account payable its supplier within that particular 30 days and actually have some excess return, some excess funds to put back into the business. So that is why it's a good thing for your accounts payable to actually be on the rise, to negotiate a higher days with your supplier. So like I said, a bad thing if it is increasing, a bad thing if it is increasing, and a good thing if it is increasing. So we'll go back to this to interpret what we have here. So we start with the receivable that we have. So it's the bad when it is increasing because our money is staying longer with our customers. So the money of the business is tied down in the hands of the customer. So we have 107 days. There was an improvement from 2021 down to 2022, from 107 days to 72 days, but it's still on the high to 44 days. So this is actually good. We can see that this is good from 72 days down to 44 days. A good thing. So we can actually see that there's a rise here also. There's a rise here also from 44 days down back to 52 days, which is a bad thing. Back up to 95 days, still on the rise. So we need to advise the company to actually drill down this to make it customers pay back the goods bought or credits on time. So we can actually put in those money back into the business to meet up with our day-to-day activities, basically. So we'll go down to our inventory days also. It takes a lot of time to convert. Look at this from 73 days to 88 to 111 days to 103 to 72. So it takes a lot of days to actually convert our raw materials gotten from our suppliers to convert them into finished goods to be available for sale, which is a bad thing. This is actually increasing. This is increasing. So we can actually see a decrease from 2023 to 2024 and a decrease from 2024 to 2025. So there is an improvement in the inventory days ratio that was calculated. So move down to our payable days. So we are from 241 days, good thing. So we can actually see a good thing here. So the business can actually invest some of the money. So look at this. We can collect back approximately 107 days to collect this back, but we are paying our supplier approximately 241 days. So the gap there, we can actually invest this money and actually plow back the profits into the business. So we have 251 days, 130, 71, and 156. So I presume along this period, the supplier actually negotiating for a lower days. That's why you're seeing a reduction here. But along this side, the business is actually paying back, then using a higher days overall, basically. So that's kind of the interpretation of the inventory days, the receivable days, and the payable days. Same thing applies for the turnover ratio. This is basically how many times you are looking at it in composition of times, composition of X, basically. For our inventory turnover ratio, it basically measures how many times a business sells or replaces its inventory over the number of period, which is basically 1 year for what we have. The interpretation basically, if it's an high ratio, it is a good thing for the business. If it's a low ratio, it means the bad thing for the business, meaning there's low demand of the goods of the business. So we can see an high ratio from 2021 to and 2025. There were high ratio, and for 2023, 2024, relatively low. So there were lower demand during this period, but higher demand for 2025 alongside 2021. Moving on to the receivable turnover ratio, it basically shows us how many times a company collect its debt from its customers over a range of period, which is basically 1 year as we're having a year. So we have over a period of 1 year, it's collected it's what's it called again? It's debt, yeah, from customers 3 times, then 5 times, 8 times, which is a good thing because for 8 times at the moment, it's a good thing because it's actually recovering its money back. So it's a good thing when this ratio is increasing, this particular ratio. It's a good thing when it is increasing. Same thing applies for payable turnover ratio. How many times the business is paying back its suppliers, or how many times its supplier is trying to recover back its money from the business. So those are the interpretation of those particular ratios. You need to actually understand the composition of this ratio and how to analyze them. Overall, in summary, you are looking at 3 things. Let's go back to our working capital. You have your accounts receivables, your inventory, and your accounts payables. So most of the ratios or the efficiency ratio that is kind of utilized majorly is the days itself. Remember, I said your accounts receivable works in line with your customers. Yeah, you're trying to recover back the more amounts of money that from your customers in relation to the goods bought on credits on the business. Your inventory days, how many days it actually takes the business to convert its raw material into finished goods. While your accounts payable, how many days it takes the business to pay back its suppliers. Like I said, it's a good thing if this is increasing. So the addition of these, your inventory plus the accounts payable, your inventory plus the accounts receivables minus the accounts payable is going to give you the net of your working capital. Yeah. So the interpretation or how we look at this ratio generally is based on the time series. We are looking at it from 2021 down to 2025. We are looking at it year on year. One of the things we can also do is basically to benchmark it against the industry. Those companies operating in the same industry, what is the average days in relation to the inventory, receivables, and payables? What is the average days they are taking for this particular ratio for each line item? Then you can benchmark this against NASCON Allied Industries Plc. That'll be all. If you have any question, you can drop it in the comment section, and I'm going to respond to it as soon as possible. Thank you.